Hey, everybody, Martin Missouri. Good afternoon. The 23rd of March, 2016. Little commentary for you and then a little charting. Um, Dow is down 80 points today. It's something that we haven't been very accustomed to over the last few weeks. The S&P was down little, well, actually 2/3%. The 82 points in the Dow would have been about 0.5%, a little less than that. NASDAQ was down 1%. So NASDAQ certainly got the brunt or got the worst of today's sell-off. Commodity stocks really got hammered. Looking at commodity indices, anywhere from 1.5 to 3.5%, particularly if I look at it beyond the indices and look at it stock by stock as well. So dollar rose today after coming down a lot last week when the Fed announced that despite better economic data, although they didn't admit to that, but I can basically present that to you that the economy actually surprised most economists this year in terms of how well it has performed. And instead of acknowledging that, the Fed actually downgraded their economic forecasts. Again, in the face of the data, I have made the contention that they're very concerned, and I'm not the only one, by the way, very concerned about markets, very concerned about the dollar. The dollar has been a headwind for manufacturing in the U.S., been a headwind for exporters. And in theory, if the rest of the world's central banks are being so darn accommodative and going to negative interest rates and creating lots of liquidity, and the Fed starts raising interest rates, well, that by the textbook definition of what moves currencies, that would force a lot of money to the dollar, make it go up after we've had kind of a reprieve, and do a number on what looks like an improving manufacturing sector as we speak. Now, I've charted for you last year why I don't know that that's going to be the case this year. I'm not in that camp. I don't think the dollar is going to be the headwind, even if the Fed raises interest rates for the bulk of the year, if you look at it start to finish. Now, I do think the dollar, like stocks, for example, can be very volatile this year. If, for example, when Britain votes, when they have their referendum on June 23rd, if getting close to that, it looks like they may exit the European Union, or if they do, I suspect the pound will fall precipitously, certainly leading up to it. That would put upward pressure, presumably, on the dollar, perhaps on other currencies, but I would imagine the euro would suffer as well. So there's a period there right about mid-year where we could see the dollar get pretty strong, and that can cause some consternation for the stock market, for sure, as well as the overall economy. So I think the Fed kind of looked at the landscape, and collectively said, we don't want to risk it right now, so we're going to be dovish. Now, since that meeting, a number of Fed members have spoken. Most of them aren't voting members, and have said that April's on the table for a Fed rate increase, which is, number one, Janet Yellen's commentary in her press conference to me was not consistent with the data. And then these other Fed governors get out and speak at their respective meetings and speeches, and they're not consistent with what Janet Yellen had to say. So I think the latter really is probably on the right track, but I do think this Fed, I'll say it one more time, is going to be exceedingly sensitive this year to a lot of things. The dollar maybe being the top of the list, stocks and bonds being on the second in terms of their priorities. So we'll see. The chart in front of you is the S&P 500 60-day, 60-minute chart. Now, I've been talking about this upward sloping wedge pattern as something that any technician would tell you suggests that there could be a downward bias, at least in the near term. Typically, you break downward out of upward sloping wedge patterns. As you can see, that happened today. Now, that doesn't mean it's going to happen in a bigger way. It doesn't mean that it's not going to come down or that it's going to come down and test some of these other key levels like this one at 20, let's call it 2020, or down lower here at 1980 or so. We very well could. Would not surprise me in the least. We still have this bubble to turn green, which would suggest the market is going to trade down at least that far at some point. As I've talked about, though, there's some underpinnings to this market that actually are pretty encouraging, and that's the overall breadth, 91% as of today. of the companies in the S&P 500 are trading above their 50-day moving averages. That's something that hasn't occurred very often, and it generally suggests pretty good things when you go out a few months. Another thing, though, worth noting is that 73% as of today, I think actually as of yesterday, of the S&P 500 stocks were trading um, at least one standard deviation above their 50-day moving average. That's where you get in the weeds, and that's where you get into these overbought territories. So that might suggest some short-term weakness, and that's why I keep talking about the fact that the market's probably overdue for a pullback. Can't seem to get much of one. Today there was, I think, a lot of reason. Oil was down 4%. The dollar going up, as it has the last few days, would put real pressure on commodity prices. But I think it was a very modest decline relative to what was going on in the world. So we'll see if there's any follow through, if traders don't wake up and say, okay, it's time for this market to take a break to the downside. But of course, time will tell. Now, again, I mentioned the dollar, mentioned commodities. I want to show you a couple of things. I think I exited my dollar chart, but let me show you commodities. Only a line chart for whatever reason on this one. It's the CRB Industrial Commodities Index. So think copper and iron ore and the things that you use to build stuff with. You can do the same analysis, technical analysis on the CRB index. And as you can see here, it was well above that 2 standard deviation, very oversold territory. And this is as of yesterday. Tomorrow I'll get the update for today's chart, and it's going to show that coming back down. Another couple indicators I introduced you to was the MACD, moving average convergence divergence. That's going to come off tomorrow and start to turn the other direction. This is the relative strength indicator, which was way above 70, which is overbought territory. So these were giving some pretty strong signals that this very nice run in commodities, and I remain constructive on commodities for the long term. But this run, like stocks in my view, got a little bit overdone or ahead of itself. Just real quick, I want to pull one more up for you. Oh, I got it. Here it is. The dollar would be the opposite end. Okay, so if you look at this is the Bloomberg Spot Dollar Index. The green line would suggest area when you get past that 2 standard deviation away from the 50-day moving average would suggest that it's oversold. And you can take a look at this one-year chart. You can see why these technical indicators are worth looking at if you want to get some short-term feel for what might go on. Look at when the dollar has gotten oversold. You can see just last week after the Fed meeting, and then it's bounced since then. Here it was oversold. Look what happened. Oversold. Look what happened. Oversold. Look what happened. Overbought, stayed there for a while, but then you see it coming down, just about, came down. Now, you can move away from an overbought or oversold position by just going sideways, and you can consolidate there, so that's also a possibility. Here, the dollar stayed overbought substantially for a while, and then boy, did it ever come down. Got oversold, came up, and so on. So, folks, this helps me articulate to you what goes on a day-to-day basis in the market, and then sometimes we have to look at other charts, like what did the dollar do today? Well, an up dollar has been something that's been negatively correlated with stocks. So when the dollar's rising, it might make sense. You can see it took a big jump today, that stocks and commodities would go down. Okay, so back to this. So we've broken out of that upward sloping wedge pattern. I think there's a good chance we could go lower. I think there's a reasonable chance we could come right back out of it. There's a lot of cash on the sidelines, and there's a lot of, I would say, underlying strength to talk about in this market. One of them would be this 50-day moving average beginning to slope in the right direction. That's a good move, and that's a good indicator, at least traditionally speaking. Notice this trend line. We haven't quite gotten up to that, but we did get up to this retracement level, right up against it, and then the market came off of that a bit. If you want to look at where we were again, I mentioned the other day that this one is starting to top out, which suggests there could be a near-term bias. This was above 70, that suggested it as well. And then those bands that show us where we are here, you can see the stocks really got into that overbought territory and still real close. So, folks, in the near term, there's a lot going on in the world, not the least of which, or even the most, perhaps the most of which, what happened in Brussels yesterday. Very muted response by the market. I talked about that yesterday, that the market has been kind of in the mood to hang in there. I actually think amid a much stronger dollar and much weaker commodities, the market gave a very impressive showing today. Um, the traders are going to think about it overnight. They're going to look at their charts, and we'll see what happens on a near-term basis. And I'll say what I always say, folks, none of this, I promise you, is actionable for you and me long-term investors. This is all just understanding some of the stuff that makes for what you might think are crazy days in the market. There's always something in retrospect that we can tie it to. And I just think that's a good idea for you to have a perspective on the short term. I'll say it again, long term I'm constructive. I think we will, as we have historically, always do well to be in a long-term, diversified, well-balanced portfolio where we're very patient and we ride through the ups and downs. Thank you, as always, for watching and listening, and I'll talk to you very soon. Bye-bye.